You may be surprised to hear this, but publicly listed REITs have historically generated higher returns than private real estate. Quite a few studies have been done on this topic. I'll put a few on the screen of this video right now, and there you'll see that REITs generate about 2 to 4% higher returns annually than private real estate. And in today's video, I'm gonna explain to you why that is. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing. And today's video, I'm gonna give you 10 reasons why publicly listed REITs generate higher returns than private real estate. Please note that this is coming from someone who comes from a private equity background, so I understand really well the appeal of private real estate, the leverage, the tax benefits, and so on. Myself also buy private real estate at times, but overall, I think that REITs are more rewarding in most cases. And in this video, I'll give you 10 reasons why. Finally, before I go into the first reason, I wanted to quickly remind you that Seeking Alpha has reactivated the 2-week free trial to my REIT newsletter, High Yield Landlord. I'll put a link to it somewhere in the description of this video if you want to access my entire portfolio. So the first reason why REITs are more rewarding than private real estate investments is that they enjoy better access to capital. A common misconception here that I often see online is that rental property investors assume that REITs are less rewarding because they cannot be leveraged. They think that their private property is going to generate higher returns because they can add a mortgage on it. Let's say the property cost 200K, they put a 50K down payment and use the other 150,000 from a bank to leverage their equity. But what these investors appear to ignore is that REITs are no different. When you're buying shares of a REIT, you're providing the equity to it. What's traded on the stock market is the equity value, so the equivalent of your 50K down payment. The REIT then takes this 50K and it adds leverage on top of it, and you benefit from it as a shareholder. So really, it's no different. It's the exact same model. The difference here is that REITs have even better access to capital, so they can access a mortgage from a bank just like you, but on top of that, they can issue public bonds, they can issue preferred equity on the public market, they can issue convertible bonds and lots of other things to really optimize their capital structure and minimize their cost of capital to earn better spreads and higher returns for their shareholders. To give you a quick example here, Agree Realty issued some preferred equity back in 2021 at roughly 4% cost. And if you were a private investor and you tried to issue some preferred equity back then, you would probably have gotten a cost closer to 10%, so more than the double of Agree Realty. The reason why Agree Realty got such a low rate is because it's really big, it's well diversified, well managed, it's highly scrutinized by public analysts, it's SEC regulated, and so understandably investors and capital providers are much happier to work with a REIT than a private investor, and so this gives them an advantage in sourcing capital at a lower cost and with better terms than you could. If you think that this content is valuable, could you please make me a favor and like the video? It really helped me a lot to grow this channel. Thank you very much. The second reason why REITs are more rewarding than private real estate investments in most cases is that their management is highly cost efficient. And this is another common misconception that I often see online. Investors will assume that REITs are going to be less rewarding because they pay high salaries, often millions, to their managers. But what they appear to miss here is that the management is still very efficient because first of all, REITs are hiring the best talent out there, so the management is going to be good. But secondly, and perhaps even more importantly, is that REITs have this really large scale, and so the management cost as a percentage of assets is going to be really small. To give you an example, Realty Income owns tens of billions worth of properties, and so despite paying millions to its top executives, the management cost as a percentage of assets is just around 30 basis points, which is really low. Now try to compare that to the management cost of a private property. If you invest in a private equity fund, typically the management cost is going to be closer to 1 to 2% per year, some promote on top of that, some acquisition fees, some disposition fees. Overall, the fee structure is going to be a lot heavier because they don't enjoy the same economies of scale, and so the management cost is going to be greater. The other alternative would be to buy the property directly and take care of the management yourself, but this will be even more inefficient and expensive because you really have no scale at all. Here, let's assume that your time is worth $30 per hour, and let's assume that you're spending 3 hours per week on your property. That's $90. Over a month, that's nearly $400. You would really need to deduct this management cost from your returns to get to a net return of management cost, because these $400 are really earned through your labor. And so if you do that, you would see that your returns will come down very significantly. Here, some of you might say that 3 hours is too much per week. After all, like some weeks you're not gonna do any work work. I mean, I used to own some rental properties myself, so I know firsthand that you don't have so much work every week, but this is an average over a full year, including the purchase. So searching the market, finding the right deal, negotiating it, financing it, marketing it, renovating it, all of that you combine together over a full year. I think it's easily 3 hours per week. Sure, once the hard work is done, the management might not take as much time, but some week you'll have issues, you'll spend 20 hours on your property, some other week you'll spend 0. It's an average, but you get the point. The management cost is really high when dealing with single properties because you have no scale, and scale really is an advantage when investing in private real estate. Then the third reason, REITs also enjoy economies of scale on other levels, and so it's not just about the management cost. They're able to save expenses on all other fronts, whether it's the brokerage, the capital providers, some marketing, some property renovations. Let's take a simple example here. Mid-America Apartments owns thousands of apartment units in strong Sunbelt markets, and so it's going to do deals with contractors to, let's say, change 50 carpets each year for its apartments in a specific city, and so naturally it's going to get a much lower cost per carpet than what you would get for your single or a few rental properties. This may not seem important to you, but real estate is a low margin business, and so being able to save expenses on every front, the renovation, the property management, the brokerage, and so on, really makes a big difference in your returns at the end of the day. Then the fourth reason why REITs are more rewarding is that they are able to develop their own properties. If you're a private real estate investor, in most cases you're probably going to buy a stabilized property, something that's fairly simple because this is a side hustle for you. It's not your main activity. You're probably not a professional real estate investor. But REITs, on the other hand, because they have the scale, they're able to hire the best talent in the real estate segment. They're able to also build their own construction arms, have their own development arm, and with that then they're going to be able to buy land, develop new properties, and in the process they'll then earn much higher returns than you would by buying stabilized properties in most cases. Reason number 5, REITs can earn additional profits on top of their real estate returns by going into real estate related businesses. And what I mean here is that, as an example, Farmland Partners has a brokerage business, so on top of earning rental income from its farmland portfolio, it's also selling properties for others, earning brokerage fees. Another example, Armada Hoffler has a construction arm providing construction services for other investors in exchange of fees. Some REITs have asset management divisions earning asset management fees. The point here is that REITs own so much real estate that they're able to use their scale and their expertise to provide services for other investors, and as a shareholder of the REIT you then participate in these fees. Reason number 6, REITs can also do spread investing when they are priced at a premium to the net asset value. And so what this essentially means is that if, let's say, a REIT is priced at a 20% premium to the value of its properties, it's going to be able to go out to the public market, issue a bunch of equity, take this equity, add some debt on top of it, and buy more properties at a positive spread. And so despite growing their share count, investors still benefit from this, because if their cost of capital is, let's say, 5%, but they're buying properties at a 7%, there is a 200 basis point spread, which is going to grow the cash flow and the dividend on a per share basis. This explains why some REITs like Realty Income have been able to consistently grow their cash flow per share by 5% annually, despite only having 1% rent hikes in their leases. A private investor who buys comparable properties will be happier with 5 times less growth than Realty Income, and so this really highlights one of the major advantages of being publicly listed and having access to public equity. 7th reason, REITs are going to be able to skip brokerage by doing sale and leasebacks directly with their tenants, and so this has many advantages. Among them, it's going to get typically better cap rates because these are off-market transactions. It's also going to get better lease terms because it's writing the lease itself. It's going to skip the brokerage fees, which really add up over time. You know, if you're buying a private property, you might pay about 5% in diverse transaction costs to buy it, maybe another 5% when you're selling it. That's a lot to make up over time. To give you an example here again, Vici Properties is commonly buying casinos from casino operators like MGM Grand or Caesars or Hard Rock. And so by buying the property directly from its owner in an off-market transaction, it's getting better terms that result in higher risk-adjusted returns over time. 8th reason why REITs outperform private real estate is that they are able to hire the best talent. And I mentioned this briefly earlier, but I want to expand here a bit. You know, REITs have really large scale, and so they can afford to pay these very generous salaries, which naturally is going to attract the best people of this sector. And naturally, when you have good management, you're going to earn higher returns. You know, they are the people who are going to be able to structure these off-market transactions transactions. They're going to be able to develop their own properties. They're going to know how to really optimize their capital structure to minimize the cost of their capital and all these other things. And so again, it shouldn't come as a surprise that REITs generate higher returns, since real estate is a management heavy business and they have the best talent working for them. Reason number 9, REITs enjoy better bargaining power with their tenants. And this again comes down to scale and diversification. If you own one or a few properties, you're really reliant on your tenant, and the last thing you want is that your tenant moves out, potentially leaving your property vacant with some need for repairs, some need to remarket it. So you're gonna have a downtime which might be complicated if you have mortgages. REITs on the other hand are really widely diversified with often hundreds or even thousands of tenants in the case of Realty Income, and so you're really able to play hardball with your tenants. If your lease expires and your tenant is refusing to pay market rent, you can simply ask your tenant to move out, because likely you have relationships with plenty of other tenants who will be happy to take the property. The tenant knows this, and so it's going to be in a weaker position to bargain with you, and it's going to likely be more likely to accept your lease terms. Then the 10th and final reason, perhaps the most important today, REITs are very heavily discounted, trading at a large discount to their net asset value. Over the past year, REIT share prices have collapsed, dropping by about 30% on average, but many individual REITs have dropped by closer to 50%, even as their cash flows have kept on rising and property values have remained more or less stable. As a result, REITs are now heavily discounted, and that on its own should result in much higher returns in the coming years as REIT valuations recover closer to the value of the real estate they own. The investment firm Janus & Henderson has done a study on this specific topic, and it found that whenever REITs were priced at a 24% discount to the net asset value, in the following 3 years they massively outperformed private real estate, more than doubling investors' money. Today the average discount to NAV is even greater than that, at closer to 30%, and so that should be a real driving factor behind the outperformance of REITs in the coming years. So these were 10 reasons why REITs outperform private real estate in most cases. Here at the end of this video, I want to remind you that we've really talked about the averages in this video. There are naturally some exceptions. Some private property might be more rewarding than REITs, but then at the same time, some individual REITs are going to be a lot more rewarding than the average of the REITs. But the point here is that on average, REITs have historically been more rewarding than private real estate investments, and that's despite being a lot safer and requiring less effort. And for this reason, I think that most individual investors should probably focus their efforts more on REITs rather than private real estate. Now, if you want to learn more about what REITs I'm buying at the moment, feel free to join my REIT newsletter for a 2-week free trial. It will give you immediate access to my entire REIT portfolio, including my latest transactions, which I share in real time with the members of the service. Also, if you could please like the video, that would really help me a lot. Thank you very much, and see you at my next one. Bye bye.